Next guest says that the stocks and bonds have been in a trading range while the bulls and bears have been duking it out. Investors are getting paid to wait. Let's bring in Emily Roland, co-chief investment strategist at John Hancock Investment Management. What do you mean? How should we do it? Big dividend yields, Emily?
Yeah, well, you've had this mantra emerging this year that the data have come in better than feared. I think we should probably have some bumper stickers made. And you've seen it across earnings results. You've seen it across the economic data. And it's caused this sort of sideways choppy action across both stocks and bonds as the bulls and bears, kind of no one's really winning here in this argument. And we're looking at the fact that you're earning 5% in yield owning high quality investment grade bonds. And you're essentially waiting, getting paid to wait as this volatility plays out and as we ultimately do believe a recession unfolds later this year. So that's our highest conviction idea. We do still want to own some stocks, but we want to be thoughtful about it. Higher quality areas of the market with great balance sheets, lots of cash on their balance sheets, a limited need to tap the capital markets in order to grow, more defensive areas of the market. We think that's the playbook for the remainder of this year.
Were a year and a half ago, were high quality bonds something you were buying, or is that a relatively recent thing?
It's relatively recent. In fact, I've been putting an outlook out for almost 10 years now. And last quarter was the first time that we have ever been overweight bonds. You know, you look at a 3-5 year time frame, stocks are always going to be a better option. They're a more powerful compounder of wealth, but we're seeing a massive opportunity here. As last year, we saw a 3 standard deviation event in high quality bonds. The aggregate bond index fell 13%, the most in history. And we're looking at that backup in bond yields as an attractive opportunity. I'll tell you, going into a recession, bond yields across the curve fall precipitously. You had a guest on earlier this morning that was talking about, Becky asked about the risks owning shorter term paper right now, which of course is yielding more than the intermediate part of the curve. The risk is significant. It's reinvestment risk. Right. A year from now, that yield is gone. So moving out the curve, locking in 4 or 5% on high quality bonds. I know it's boring, but I think we're going to look back on this as a really attractive entry point.
Right. Back when, back when I walked to school both ways uphill. No, but back when tax-free bonds were 13% when I was a stockbroker. Triple tax-free bonds were 13%. So think about, what was the risk of buying a 1-month piece of paper when you had 20-year tax-frees at 13? The opportunity that you missed for something like that is staggering. What did you get in the high yield corporates that you were buying? Could you get 5 and 6%, Emily?
Yeah, and right now, by the way, speaking of high yield, you just don't even need to go down the credit spectrum in order to generate yield that attractive. So, from here, we see the opportunity not only for duration to become a significant tailwind. In fact, the yield on the 10-year Treasury falls on average about 2.5% into a recession, looking back at the last 4 cycles. So that's almost a double-digit duration tailwind, in addition to the 5% you're getting on investment-grade corporate bonds. Yeah. So to us, we're doing the math on every asset class across markets, and the math just isn't that good anywhere else today.
If long-term stocks yield 6-7%, you can get, as you're saying. What about converts? Do you do some converts too, preferreds or bonds?
Yeah, I mean, not the worst area, but again, if we were to kind of stack rank them, again, high quality bonds would be number one. Potentially, going into credit over equities right now. Look, the S&P 500 is trading at 18 times forward earnings right now. I do think that there's some pockets of opportunity. There are a few areas that are trading at a discount. We look at mid-cap value as one of those places in the market, but there's just not a lot of stuff on sale today. We want to wait out this late cycle environment. Markets are chopping around. We do think that they eventually respond to the lagged impact of Fed tightening, but right now we're in this never-ending late cycle environment where it's taking a long time to squeeze inflation out. So we want to still have exposure to some offense in the portfolio as we wait this period out. We're treading water. It's getting tiring to continue to tread water by participating in this market. But I think owning quality, owning defense, yield, embracing bonds is the name of the game.
When you go up 500 basis points, you might as well own some yield, whether it's stocks or bonds. All right, Emily. Good advice. Thank you.